All right. Well, thank you very much, everyone, for joining us. It is part 2, real estate restructuring in the aftermath of COVID-19. We've joined with a terrific panel of experts where we're going to be revisiting some of the topics that we talked about 90 days ago, June 30th. It should be it was a lively discussion then. It should be a lively discussion now. I have a very short disclaimer that the following commentary is for educational purposes only and not an offer or solicitation. This communication should not be viewed as an investment, legal, or tax advice from Nixon Peabody, including its subsidiaries and affiliates, or any of the panelists. Information provided is subject to change at any time based on economic, market, and other considerations. It should not be construed as any recommendation. Forecasts and past performance should not be viewed as an indicator of future performance. Forecasts are based on assumptions, estimates, opinions, hypothetical models that may prove to be incorrect. And everyone on this call should seek their own advice from their professional advisors related to their specific situation. Again, we are, as I said before, we are joined by a terrific panel of experts. You'll see just some housekeeping items. You'll see that there's a Q&A function on this Q&A box. If you do have questions, please put them in there. We will try to get to them. But I will try to cover as much territory as possible. We only have an hour, so we have a lot to cover. So we'll try to get to everything. But if you have specific questions, put them in the Q&A box, and we will try to get to them. Our panelists are the same as we had last time, with one incredible addition. So I'll get to the original panelists. So Andrew Hundertmark, who's the Chief Executive Officer of Argentic Services Company. And Andy has a long history of working in real estate. He was responsible for overseeing a professional staff of 20 employees. They're a special servicer, total of 20 CMBS and CLO transactions with a notational value of over $12 billion. So definitely knows the landscape of what's happening in especially with special service situations. We're also happy to be joined with Bob Lieber, who is from Island Capital Group. And importantly to know that, Bob was a deputy mayor for economic development under New York City Mayor Mike Bloomberg, and a long history in the investment field. We also have with us Ackman-Ziff from Phillipsburg, Pennsylvania. Simon is the president of Ackman-Ziff Real Estate Capital Advisors, and Ackman-Ziff is a pretty active real estate capital advisory firm, and has done a lot of deals across sectors. You'll be hearing from Simon about what's happening, especially in capital formation. And of course, I'm delighted to have with us Colette Dafoe, who is the managing partner of Nixon Peabody's DC office, and she focused her practice on commercial real estate transactions, and has, I think, the last several months, as she'll talk to you about, been very involved in some of the special situations and some distressed real estate, as well as probably doing some other deals. And then our new addition, which I'm very excited to have, is Erica Buckley. And Erica leads Nixon Peabody's cooperatives and condominiums practice, which is relatively new for the last couple of years that we've had a practice focusing on that. And she's just done a terrific job. I think she probably is probably the foremost expert in cooperatives and condominiums. And she sits both in our New York City office, but also has just opened an office up in our Albany office. And so we're really delighted to have Erica, who was not with us last time, here with us right now. So we're going to get right into it. So I have the advantage of, I just went back and watched the program we had end of June. So I'm able to kind of ask some of the questions that some of the advice that you guys gave last time. I can kind of question, see if you're right or not. To see what's going on. So first going to Andy. Andy, in June, you were pretty pessimistic about the next 90 days, and you predicted that 2 to 3 more assets would be transitioning to special servicing by this time. So what have you seen in the last 3 months?
I wasn't pessimistic enough. We now have 52, 53 assets in special servicing. Most of them hotels, a few retail, a few office, but primarily hotels. And while the number of transfers have slowed over the past month or so, I fully expect with the onset of winter that some of these borrowers who are hanging on by a thread and got a nice little boost of summertime and even fall time travelers are going to lose that little boost in the winter, and they're already in a weakened state financially, so I fully expect to continue to see defaults and see transfers in.
So I think I don't know if we lost Andy or not, but so I mean you're seeing it escalating. Is it going faster? Or is it going slower? What's the?
Yeah, I would say they came in after that initial wave that we discussed in June, where we had a lot of the short-term relief consents that were almost overwhelming in number. In July, August were fairly brisk in terms of transfers into special. They have slowed down. September was not too active. It's typical that around the middle of the month is when we get kind of the next group come in, because the payment dates on these in the CMBS trusts are typically the 5th, 6th, 7th of the month. So once you click that 60-day past due, then the asset's going to transfer in, and that transfer process from the master to the special typically takes a week or so. So hard to say what October will look like. I think, as I said, a lot of folks brought their loans current during the summer, decided to just kind of gut it out and hope things continue to improve. And I think October will probably be another slow month in terms of transfers in, but I think probably November and through the winter is going to be a tough time. Obviously on the hotel front, but I also think a lot of the retail strip centers are hanging on by a thread, and if we get another COVID wave, or we get a particularly cold winter and people are not able to willing or able to go outside even to pick up food, I think you'll see some of these smaller retail centers really start to struggle more than they already are.
Thanks. So Bob, it sounds Andy, it sounds like he's seen definitely a downward trend. The one thing you commented on was that you didn't think we would see any more clarity in the next 90 days. Do you have any more confidence in the overall direction of the economy today than you did back at the end of June? I think you're still on mute. Bob?
Are you there?
Yep, we can hear you now.
David? Okay, I'm sorry. Sorry about that. This work from home, even though I'm in the office, is still confusing to me. Sorry. I'm not sure about clarity. I think there is more direction for sure here. And I think just briefly by background, Island Capital Group and our predecessor companies are active, have been active in the commercial real estate business since the late 80s and the early 1990s. We're participating on all different sides. We're active advisors, we're active investors, both in real estate equity and CMBS, and until recently owned one of the country's largest legacy CMBS special servicers. So over those 3 or 4 decades, we've seen various versions of this movie before. And, no one ever really knows what's going to happen and when. However, what I would say, it is clear today that the downward momentum in the commercial mortgage defaults is going to continue and has continued. And we shouldn't be surprised. Shutting down the economy has major negative impacts on real estate assets. And he talked a little bit about this, but, in September, 26% of hotel-backed CMBS loans are in special servicing, and about 19% of CMBS loans secured by commercial real estate properties are in special servicing. And both of these rates are the highest that we've seen on record. And no participant has ever seen this kind of record wave of defaults, and it exceeds what we saw even in the Great Recession in 2008 and 2009. Hotel loans are the biggest problem for sure, but 53% higher than the delinquency reached in the in 2008 and 2009. And we're seeing special servicing rates on office, industrial, multifamily about 3% of what we see in special servicing. So there's still a lot of momentum, particularly around the hospitality and the retail space. When we look a little bit more deeply, peel it back a little bit, it's easy to do broad groupings of these different assets, but luxury hotels in the major cities have been the hardest hit in the hospitality sector because they're more dependent on business travel and larger events, conventions, et cetera. Interestingly, 50% of Chicago's hotels are in special servicing, and over 45% of New York City's hotels are in special servicing. And these, what we have seen so far is that the lenders, and Andy talked about this a little bit, have been pretty forthcoming around forbearance and other relief measures for struggling borrowers. But the country continues to wind into this process here, and we're in the 8th month of this coronavirus epidemic. I think the measures are starting to expire, and we'll see what really happens from here. Everyone wants forbearance. The expression today is patience and extend, except, as opposed to just avoid it and extend. But right now, the valuations are still very, very uncertain about what's going to happen with these assets. And when you're given the disruption and the underlying NOIs of these assets, it really doesn't matter what cap rates are. And so far, there's been a striking dearth of transaction activity. And Simon could probably talk more about that. The banks are in triage. The special services are overwhelmed. It'll be nice when we get out of this COVID era, from my perspective. But we're deeply mired in it, David, would be my conclusion.
Thanks. Yeah, so Simon, picking up on that, I think you talked last time about the fact that capital formation was really constrained. Are you seeing it, especially in retail and hospitality? Are you seeing, there sounds like there could be some good deals out there. Is there any money on the sidelines or in the playing field looking to snap up these assets?
Sure, David. I think the story of equity is similar to what it was 90 or 120 days ago. There's plenty of it, and it wants to invest in real estate. But the direction it's been getting is to find something that is a discount to pre-COVID pricing. And so it could actually be a little expensive, but if you can tell the story that it's discount to pre-COVID pricing, it seems to resonate well with equity investors. And that hasn't changed too much. In terms of timing, there hasn't been a lot of transactions. We're still going through price discovery. And Andrew is in that key spot as one of the specials holding the keys to when these things are going to happen and when they put the pressure on the borrowers to either pay them back or give back the keys. And so what we're hearing from most of the special servicers in the banks is there'll be very little activity through the end of this year, although some might create some activity. I would say one or two of the specials have told us they expect to see some trades, but there have been very little trades. And if you look at all the volume of sales, they're way down. Now, the debt capital story has changed quite a bit since our last session 120 days ago. We had an extremely busy 4 months. We've closed 4 loans, and those were all post-COVID. They all began post-COVID. Almost everyone was a refinancing. Although tonight, I think I'm going to a closing dinner for a $90 million shopping center loan we closed in Nashville. We've done 6 deals over $90 million in the last 3 months, mostly office. There were 4 or 5 shopping centers in there. There was only 1 hotel. To their point, A notes on hotels are brutally hard at any kind of cost. B notes and mezz for hotels are everywhere. Everybody wants to do the sub debt on hotels. But most of those financings were large office and large multifamily transactions where the markets are working pretty well. But I should caveat that because of those 30-some transactions, that they were done with almost the same number of lenders. And many of the lenders that did those deals were lenders I hadn't even known or had heard of before the process. We've gone to 100 lenders on some deals. We've gone to 200 lenders on some deals. So there is capital, but it's really, really difficult to get deals closed.
Thanks. So, Colette, you talked about the fact that you heard that people are talking about how hospitality is particularly under pressure. What are you seeing from your clients in terms of being creative and trying to stay alive, trying to stay afloat, and not going to default, or at least creating a path to staying out of the red zone?
Sure. So, I want to start by just echoing what we've heard already across the board. Hospitality industry is definitely taking a big hit. The forbearance periods have generally run. The PPP loans are out, so those defaults are really starting to pile up. From a special servicing side, I think we are really just starting to test the waters with remedies. So, just starting that enforcement process. And so our borrowers haven't had to be super creative yet, but there's some that have thrown some wrenches into the mix. Some of the hotels that I've seen have actually have agreements with local municipalities, with the city, to house the homeless population. So they've seen how they can actually bring in cash from the city even when the occupancy rates are extremely, extremely low. Obviously, there's going to be a backlog with the courts for judicial foreclosures, for receiverships, for any possibility of enforcement. So borrowers will continue, I think, to be creative and to come up with those, like Bob was saying, asking for patience, but in creative ways. But I do think the lenders are going to flip a little bit because they have been so focused on the forbearance and getting the PPP loans out that now they're going to be really looking at their books and looking at a lot of these loans. And I think the enforcement will start to come. I think patience is running out. So even though I thought maybe this summer we were at the tipping point, I think now we're at a tipping point. It could be a big flood for year end. I come back to me though, David, for a positive note though. Okay, I don't want to be the Debbie Downer for the entire presentation.
Well, I spoke. That's a good segue because I spoke to your colleague Erica, our colleague Erica, just before the call, and she actually seemed pretty positive. So, Erica, what's happening in condos and co-ops? How are they escaping the what sounds like a pretty dismal market?
Yeah, and let me just start off by saying that if I had been on the panel 120 days ago, I may have been a little bit more doom and gloom. And that's because in 2008, at the time of the big financial crisis, I was regulating the condominium market at the Attorney General's office. And I just remember there was a glut of inventory. There were thousands of purchasers in contract that wanted out, that were looking to the Attorney General to help them get out. And it was just an absolute calamity. And my experience to date has just been quite different. And it's, not to say that the market hasn't been impacted at all. That's not the case at all. But I think it's really completely different. I will say that, I have seen a slowdown on luxury, high-end condominiums in Manhattan. That's something that I've definitely seen a slowdown in. Same with rental to condominium conversions. That was obviously impacted by the changes to the rent laws regardless, but nobody's doing conversions, and the luxury condo deals we have are a little bit slower. But we also have a lot of developers that are doing new construction condos in Brooklyn. We had one developer that released a project in the middle of the pandemic, small building. Within a month, half the units were in contract. I couldn't believe it. And with pretty reasonable concessions that, quite frankly, I would have seen before the pandemic. And why do I think this is happening? And, what's different from 2008? There isn't as much inventory. We have incredibly low interest rates, and people do still want to own their homes. The other thing that I'm seeing, which is kind of good for me personally in the firm, because as you said, David, right before COVID hit, we made a decision to expand the condominium practice into upstate New York. And upstate New York is on fire. It's unbelievable. I think that you're finding more and more people that, have tried to either live in Manhattan, live in Brooklyn, maybe Queens, and they may not see themselves coming back to the office, but they want to have a close proximity to the city, and they're looking to live outside of New York, and not Westchester, but, the Hudson Valley region, the Capital District. I will tell you, I've got my finger on the pulse of the upstate market. Homes are they're listed, and they are in contract in like 24 to 48 hours. I read the Albany Business Journal every day, and it's like there's a new, condominium project being proposed. So I think that, and again, that's not something I think we would have seen in 2008. It was like everything stopped. It was all doom and gloom. And I think that, developers, despite everything that's going on, are really trying to keep things going. And I think, again, that's great. And we have, again, lack of inventory, so there are a lot of buyers that are out there and they're ready to go. And we have historically low interest rates. So that's another positive, too. And again, it's not to say that, in 3 to 6 months, I won't be telling you all about the deals that I'm helping to restructure. But as it stands now, the market seems to be doing quite well. And if I had my, my magic ball, I would say, probably within like a year or so, it could go back to pre-COVID times and be, look a lot like it did before COVID.
Great. No, I just want to go back to Andy, and Simon said that he doesn't see a lot of deals going on, and doesn't hear that there's going to be a lot happening this year. Can you give us an insight into your thought process into what point do you? This actually came in through the chat function or the Q&A function too. What point do you decide that you should kind of force a transaction to get a recovery versus letting things kind of play out?
So generally, our philosophy is, we're really trying to exhaust the negotiation process and probably pushing that farther than we did 10 years ago in the Great Recession, when people were in the situation they were in because they were over-levered and there were macro forces at work. Now that it's the negative impacts have been caused by act of God, you really want to try and see if you can come to a meeting in the minds with a borrower. Who, do you have a good borrower? Are they capable of contributing financially to a forbearance, to an extension, to a modification? Where do we see the market in 3 months, 6 months, 9 months? We're trying to work collaboratively. We've had some borrowers, for example, down in Savannah, Charleston, Hilton Head area, who have come in and asked for forbearances for September, October, November, December. And response to them is, okay, what are you going to do in January? you're not in season yet. Don't you think we need to figure out something that might get you through March or even to Memorial Day, when you should start seeing some decent traffic in the hotels, and can start to pay your loan again and start to repay some of the money that's been forbeared upon? So it's a more collaborative effort. We are just now, I think, reaching the point with some borrowers, some properties, where we're seriously, we're interviewing receivers, we're interviewing property management companies, we're interviewing leasing brokers, etc. We have not, with a couple of exceptions, we've really not filed foreclosures. We've got a lot of receivership actions that have either just been filed or are in the process of being filed. I think the jury is still out on, how, not that the courts are a monolithic being, but how the courts in general are going to respond to all these foreclosure and receivership filings, which is one reason that we really want to exhaust the negotiation tactic. It's easier to go in front of a judge and say, Your Honor, we've exchanged proposals over the last 3 months and we just can't get there. That's a much better, works much better in your favor than going in and saying, Your Honor, no, we didn't talk to him, we just want his property. So I think, to Simon's point, and what he's hearing from other folks, we may have a couple of assets dribble out before the end of the year, but I really think it's 2021 when, when we become more serious about selling, whether it be loans or REO. I don't have any feel for that right now. I've heard from a lot of folks that they think loan sales are going to be leading the way because of the backups in the courts and because of judges who may be slow or hesitant to grant a foreclosure, and therefore, if you want it off your books, you go the loan sale route. I don't know. I think that's really yet to be tested. I think everybody's got their own theories about how that's going to work. And again, the courts are not monolithic, and I think every judge is going to follow the law, follow their conscience, and look at each deal on its own merits.
Yeah, I think the timing issue is a good point. It reminds me when I was in the wholesale business, and I'd have to call an account up in January, a retailer, and say, what are you going to pay me? And they'd say, I'll pay you in a couple months. And my comment was always, this is the time when you have the most cash. Your cash will only go down for the next 3 months. So, if you can't pay me now, I'm not sure when you're going to be able to pay me. So I think that's a great point. And while we're on retail, one of the things that we're hearing a lot about, even in the mainstream media, people are talking about percentage rents are coming back in retail. Is that something that, especially for, and also in dining, so restaurants, are percentage rents, as hot as we're hearing? If they are now, is this a fad, or is it going to stick? Open up to anybody that wants to answer.
Fad and all the rage have a positive implication to them, David, but I think the restaurateurs are struggling more than anybody, and it's really sad for those of us that enjoy dining and we go see our friends who own restaurants and the amount of struggle they're facing. I think getting any rent from them is a fortunate thing because they're losing money. They're losing a lot of money. And, for example, in New York, where we've enjoyed the outdoor dining in the evenings and in the day, they're still way under capacity, and they're allowed to open 25%, and you can't make money there. And with the weather changing, they'll have to shut the outdoor dining down probably pretty soon. Those heaters only work between like a 3-degree range where they make it comfortable. So it's really troublesome, and I expect, and I've talked to a few of my friends that have closed their restaurants and that haven't closed their restaurants yet. And some of the great restaurants in New York will close their restaurants probably in the next 30 or 45 days. So any rent is fortunate, but hopefully the spring will come and they'll open up again.
I would agree with that. Desperation is what's causing the percentage rent today. And I think underlying all of this is, the reliance on coming up with a verifiable vaccine. And what I worry about from an economic point of view is the momentum or the kind of the logarithmic effect of every day that goes by that businesses are shut down and compromised. Because a lot of businesses are going to fail because they can't get there. There is the light at the end of the tunnel is coming right at them. So it really, really depends on when we're going to have a verifiable and supportable vaccine that people can take advantage of before, or a lot of these businesses that are operating businesses and supported by operating businesses, restaurants and retail and others are going to just fold up and not reopen at all. Whether they have percentage rent or any rent, they still can't make any money. So it's really important that we have that kind of a vaccine, I think, in terms of what's going to happen, certainly in the urban markets.
If
it goes another year or so, we're in terrible shape.
Bob, is that the same thing with offices and offices coming back to life?
Yeah, I think no one really knows what real office occupancy is today. Somewhere between 10 and 20% here in New York. But they're leases, and the office owners and the lenders against office assets have more time, right? And then there's always the debate, and we talked about this 3 months ago, about density versus, co-working space. So I think, will tenants need an equivalent amount of office space because their lesser staff needs more space per head? Maybe we'll see. I believe a lot of this is going to revert to the mean, but it's only going to revert to the mean if we can get to a solution on the healthcare problem sooner than later. And so office delinquencies right now, or loans in office, at least in the CMBS world, and Andy knows better than I, is less than 3%. So that default wave hasn't come into office yet because tenants are still paying rent by and large.
And
Colette, are people renewing their offices?
Asking rents are going down. I'm sorry?
I was just going to jump in, David, because what I'm seeing right now, anybody that had a lease that was coming up, so expiring soon, they are already under negotiation, and I have some that were negotiating 90,000 square feet that dropped it down to 30,000 square feet. I had one that was negotiating 75,000 square feet that's now negotiating 16,000 square feet. So they dramatically altered. I know it is right in real time, right? So they are dealing with a population that is not in the office, not at their desk at all right now, and they're in a situation in a time period where they have to make a decision. But it's dramatic.
I have a question for
Colette. Do you see the terms of these office leases also shortening as you go, as people want more optionality around what they're doing?
Absolutely. I'm seeing shorter terms. I'm seeing requests for earlier terminations, less notice to exercise those terminations. Building in as many tenant-friendly options as possible. And I think that right now, given the uncertainty, I think they have a little bit of an advantage.
Simon had a question too, I think.
Bob and I think alike.
Colette, just my question is: Are the landlords acceding to these conditions, these tenant-friendly conditions?
Well, they're certainly negotiating for the smaller spaces. I've seen some of the lease terms come down because they just want to make sure they have some space filled for some period of time, get them through this period. But I haven't seen the landlord say yes to dramatically tenant favorable provisions. So they're still, when we were talking about being creative earlier, I think some of our landlord developer clients are basically trying to give tenants some favorable deferments or forbearance in landlord-tenant suites for some period of time, but they're trying to get something on the back end. So they're trying to add some time to the lease. They're trying to reduce extend out the termination provisions. get back some good space in the building if they think they have other options. So they're negotiating. They're trying to be creative and take advantage of the situation. But they're also, to Andy's point earlier, with respect to the lenders thinking, okay, we gotta keep pushing this forward. We're not quite ready to take over these properties. We got to do something to show good faith here. I think the landlords are doing the same thing. They're having those conversations with the tenants and creating payment plans. So they're not saying you don't have to pay anything. They're saying pay something now, and it's extending out over some period of time.
I would just add to that a little bit. I'm sorry, David. I was going to say, as owners, we look at this and we see initially with the onset, we had a lot of tenants raise their hand and said, we need help, we need forbearance. And we said, okay, show us what your financial needs are. And a lot of people, when we asked for that, put their hands down and then went ahead and continued to pay their rent. We as owners want to continue to see the cash flow coming in. So we'll make deals with the tenants and we'll do a forbearance, but we'll add it to the back end and or amortize the increase over the remaining period of the lease, because we're all better off if we can keep the tenants paying cash as we go.
Yep, totally agree.
So the one bright spot that came out of last session was the industrial distribution warehouse real estate, which I think sounded back then that there's still a lot of interest in that, especially as the new normal. The whole distribution system gets disrupted. Is that still happening? Is that cooled off? What are we seeing in that space?
The good news, at least as far as my portfolio, is we're not seeing anything. So that's a good thing for that particular.
No news is good news.
Yeah, for that particular sector. We have nothing in special, and we may have, a small handful on the watch list for one reason or another, but not something that we lose any sleep over.
I would add, when you look at this, you just look at the digital adoption rates that are taking place across America, particularly older Americans who need still essential services from retail, from Walmart, from Costco, and these other places. Being able to order online and have it delivered or pick it up without having to go in the store makes a big difference. And that clearly is helping the industrial and the last mile of distribution for sure.
Yeah, thanks, Bob. I'll have to remember that I'm now a digital adopter, as I'm an older person, so I'll work on my digital adoption.
my wife's in the retail space in the credit card business. She says the digital adoption rate for some of the biggest retailers, they've done 5 years of what they projected in 3 months. So they are completely changing how they think about retail, if you can believe it, even in the big distributors.
Great.
So David, get digitally hip, man.
I would add to your list, David, on what we're bullish about is I think the life science buildings are still a great asset. We recently closed on the acquisition of a large life science building, and they just continue to expand.
Where was that? Where was that? Was that a metro, a non-metro, office park?
Yep.
Metro?
Yeah, Metro. I'm guessing life science buildings are not showing up on Andy's books yet either.
Great. And we talked very negatively earlier about hospitality, but is there any space, any kind of geographies, any places that you're seeing any life in that? I'm here in California, and I'm hearing that some of the kind of the more remote places, the rural places, that people go for nature, are seeing some activity. And so is it all bad, or you're seeing pockets of some success in that, and you see that going forward?
I think you're seeing some pockets of mediocrity as opposed to pockets of
I like that.
of total weakness. We've heard a couple of, or been involved in a couple of situations where, borrowers have come in, asked for forbearance. We've gone through the process. We've approved some relief for them, and then they've said that, you know what, we think we're able to keep it current. We're actually getting decent traction, and these are, limited service or maybe even full service hotels in the middle of nowhere. And they're saying, we're amazed. It's just people who want to get away for a weekend. They don't care they don't care so much where they're going and what there is to see. They just want to get out of their house. I think it's great. I think it's a short-term phenomena. And I think that for a good part of the country, it will be coming to an end over the next, 30 to 60 days. I mean, maybe you'll want to drive somewhere and hole up in a hotel room instead of holing up in your living room just because it's a change of venue. But I doubt it. I think you'll still see some reasonable success, along the Florida coast, in Southern California, maybe along the Gulf Coast if the hurricanes leave any of the Gulf Coast by the time the season's over. Where people want to get away, they want to go to the beach, they want to see the water, they want to feel the sun. But I think for a good part of the country, these hotels are entering it in a very weak financial position and just don't have the staying power.
There's a lot
I
of
would only add to that. I think I'm sorry. I was just going to say drivable destinations. Sorry, Erica.
Let's let Erica go.
Go ahead.
No, Erica, you go.
I was just going to say to continue promoting the activity that's happening in upstate New York. There's actually some conversion of traditional hotels to extended stay. And there is a lot of interest. And again, I think, if I had to predict, I would say it could be more of a long-term thing versus a short-term thing. Living in metropolitan areas can be, exciting, but something that I think people also enjoy getting away from. So I wouldn't be surprised if some of these, hotel conversions to either extended stays or, dare I say it, timeshares, I think that they could actually be successful, and it might be a really good reuse of that asset class. And, the activity is definitely quite strong right now because, again, people do want to, people that are living in cities want to be able to escape. They want to be near nature. They want to, breathe some fresh air. But that becomes kind of addictive. It's something that, really can increase, your quality of life. And, for people with means, I'm not sure why they wouldn't want that to be something that is ongoing.
I do think adaptive reuse, while we've used it in the retail space for a while now, I think it is moving into the hospitality space. I was talking to a broker yesterday who just closed on a sale of a hotel in downtown Baltimore here, one of the older hotels downtown. It's been reflagged and pipped several times, but it just sold at a very good price to a workforce housing developer. So he's gonna, shut it down as a hotel and turn it into workforce housing, which I think is a great idea. We've got enough hotels in that area, and I think they were suffering anyway. So I think you'll see some creative reuse of what in many markets was an overbuilding of hotel rooms.
I'm gonna start looking for my timeshare in Niagara Falls sometime soon. So I can't wait for that. So that's great, really interesting. So I was interested in the fact that if you read the media again, you see a lot that rents are falling. So around the country, here in San Francisco, we've had just dramatic decreases, but also other places. And Simon, it sounds like you're doing a lot of refinancing. How is that? How does that play out? That rents are falling, But how does that impact asset value? How are you able to kind of evaluate where's all that going to land?
Well, I think the assets that have a lot of uncertainty are incredibly challenging to finance. So if you have an office building with a tenant rolling and that tenant is, if it's unclear whether they're going to stay in 200,000 feet or they're going to shrink to 100,000 feet, we have a problem. So we've fortunately been able to get done deals that don't have that. There haven't been, as we discussed, a lot of sales. We did see one asset pre-COVID that was under contract at $62 million, and then we sold it during COVID at $62 million. It fell out of contract. Obviously, the rents were lower, but somebody was willing to take a bet that they'll pop up again. But David, this price discovery is the issue for transactions now, and the rents are the driver of the values. So are we a long-term underwriter of a $5 drop or $10 drop in rents, or is it a temporary thing? And those assets, it's very hard to transact a buy sell, and it makes the financing pretty hard too.
Yeah, I mean, real estate, residential as well is suffering also. So I think that's, people are just wondering how low does it go, as the saying goes.
That's put a freeze on a lot of transactions.
Bob, where do you see the values ending up? Are you trying to make any kind of determination in your investment?
Look, I think it depends. It's very market specific. We're looking at lots of opportunities in New York City because of the downturn here. We've been through a lot of cycles in New York City. We think the benefits of being in an urban environment are going to prove themselves out over time. Clearly, the healthcare scare here is what's driven a lot of this. So I think there is pressure. I think there's more pressure in New York than Erica sees from her side that we see on the supply side, and particularly in the newly constructed condo. And if I look out the window here and see all the cranes that are still hanging in the sky, there's going to be a lot of overhang on that. And I think that's going to be a part where there's going to be opportunity. I don't know when that's going to break. There hasn't been anything that's really traded so far in 2020, but I think 21 and 22, we're going to see, more activity. I think kind of what Simon was saying as well here, and Andy as well. I think kind of conclude on that as well. But I think there is more supply, and the supply is driving a lot of rent down. And I think you see in the major urban markets where cost structures are high, people who used to rent have decided to move to the burbs or move back with their parents. So real rental rates are come down dramatically as well. So it's going to take this, as I said earlier, the turnaround with the vaccine, I think, to try and stem this migration of people out. When I think it does, I think we'll see the cities come back and be more popular.
Erica, you commented that you thought there was some developments coming, especially as you said upstate. Do you see that as a trend that's going to continue? At some point in time, does it get some level of readjustment? Where do you see that trend, kind of bottoming out, or do you see it, going on, continuing extending?
Well, I mean, I actually think it's going to continue. To what degree? I mean, no one can be sure, but at least in the upstate region, which is quite different from downstate, where you're correct, Bob. There's a glut. There's no inventory. I mean, inventory of homes is at like a 40-year low. So, and if people are looking for your traditional single-family home or something that's not your apartment building or condo unit, the inventory is exceptionally low. And I think that, again, in my mind, it's possible that this, remote work is going to stay, maybe, and I hope not to the degree we have today. But if we have fewer people working in urban areas, it's just, it seems pretty logical that more people will want to have, homes outside of the city. So I think it could continue. And also, I think it is possible that, of the luxury, condominiums that we have right now that aren't selling, they could potentially be, repositioned. The last downturn, the city tried to incentivize owners of condominium units to turn them into affordable housing. That didn't really happen. I think the market just, improved too quickly. So it remains to be seen if that happens. And that's also something that I have been seeing a lot of activity. When COVID first hit, the city sort of put all of their affordable home ownership projects on hold, and within 90 days, they were all back on schedule. So I've seen a lot of affordable home ownership deals. You know, the city's committed to funding. We just closed one this week, and we have quite a few other ones that are committed to close by the end of the year. So that's interesting. So, I mean, it's no secret. Anyone that knows me knows I'm a huge fan of home ownership, and I think that, you know, the city's low home ownership rate should be increased. So it'd be great if, you know, one of the things that we see come out of this is more, you know, middle market affordable home ownership.
Great. Well, we've actually almost eaten up all of our time. It's gone very quickly. So it's been incredibly interesting. We've heard a lot of predictions so far, or at least some insights into what will the future be. But as I did last time, I'm going to put all of you on the spot again to give me what your thoughts are in terms of, you know, what's it going to look like if we come back, say, in January, maybe middle of January, and would have this conversation again. You know, what's your prediction for, you know, how things have gone? We'll start with Colette.
I think we're going to have a very challenging year end, but what I'm hoping is that because I think most people recognize that this is not going away tomorrow, the world's not just going to right itself and everything goes back to normal. And as people start to really see that and recognize that, they really do start to come up with some creative solutions, and that we get some real, I think, innovation and exciting changes. So maybe at the end of the day, this can be a disruptor that has some positive impact. So that'll be my positive spin for you, David. I do think we'll be having some rough conversations in January, so.
Bob?
I'm going to dodge the question slightly, David, by saying that I think by the end of December, not much is going to be different, but we will begin to see real price discovery as the rest of the fiscal incentive runs off here and the patience of lenders begins to wane a little bit, and borrowers get more and more desperate as they go. I think you'll see more price discovery, more transaction volume, and you'll have a clear indication of where values are really headed in the near term. But I don't think we're going to see anything meaningfully different between now and the beginning of 2021.
How about you, Erica?
I'm actually hoping that, you know, things are very similar, you know, at the end of the year as they are today. So I'm hopeful that, you know, if we talk at the end of December, I'm not talking about purchasers, you know, desperate to get out of contracts and no units closing. I mean, look, it's a tough, challenging time. But again, when I compare it to what the for sale market looked like in 2008, I think we're okay. It's not fabulous, but it's not absolute doomsday. So my prediction would be that I'd probably be, you know, giving the same talk over, and that I think would be okay.
Andy?
I think from the special servicers point of view, I think January, February will probably be the peak of the or the trough, I guess, depending on how you look at it, of distress. I think that, as I said before, winter will unfortunately put a final stake in a lot of these folks who have hung on to this point, and I think we'll see a decent uptick in specially serviced assets, and hopefully the balance of 21 will be less painful for everyone. But I do agree with Bob's earlier comment with regard to a safe and effective vaccine really being the key that unlocks the recovery.
And Simon, predictions on Nittany Lion football and the real estate economy. Simon?
I lost my unmute. I do agree with Bob on price discovery. We'll see a lot more of it December-ish, January, and with Andy on the amount of distress I expect in the first quarter. By the way, I was distracted this whole time by you touching your beard, David. And is it soft or is it really bristly? Because none of us can tell.
It's a virtual haircut. It really doesn't work well.
Very distracting. Very distracting. I almost didn't hear my questions. As far as Penn State football, good question. It depends how many of our players are healthy without the virus each week. And that's going to determine who has the best team this fall. So hopefully, as you know, they haven't released who's healthy, but we'll find out soon. We have a good team.
Hopefully they'll stay out of there. Hopefully all the players will stay out of the bars on College Avenue there and, stick to the bubble. So it's been great. I think we've exhausted our time, which is shocking again because I think it went very quickly. But we learned a lot. I certainly did in terms of the last session was very informative. This one was just as informative and interesting. And appreciate you all contributing to it. This was recorded, so we will have a recording available probably in the next day or so. But thank you so much, and stay healthy, and please stay safe. And we'll be maybe talking to you back in January. Thanks, everyone.